What happens when a brokerage firm decides to not only represent tenants, but also develop and acquire properties? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Today, we're diving into the story of Charter Realty and its sibling company, Zelco Properties and Development, as they strategize their growth in the greater Boston retail real estate market. Charter Realty, based in Westport, Connecticut, has been making waves with its recent opening of an office in Dedham. By hiring top executives from WS development and brokerage firm Avison Young, they're expanding their landlord and tenant representation and development activities. Zelco Properties and Development is specializing in acquisitions and development of suburban grocery-anchored and mixed-use developments. Charter Realty began as a brokerage firm and has evolved into a company that develops and acquires properties, leveraging its strong relationships with tenants. They manage around 65 tenant representation accounts, both regional and national, and handle approximately 8 or 9 million square feet of shopping centers for landlords. The climate for retail site acquisition in Greater Boston is challenging, especially in terms of approvals and finding available sites. Charter Realty's deals often involve some level of development or redevelopment. Recently, they brought on industry experts like Jeff Arsenault from Avison Young and Brian Furs from WS Development to strengthen their team in Boston. Currently, Charter Realty owns about 30 properties across Connecticut, Massachusetts, New York, the Carolinas, and Montana. They've recently acquired a shopping center in Guilford, Connecticut, which includes tenants like Fresh Market, Michaels, Old Navy, and TJ Maxx. They're under contract for commercial properties in Massachusetts and Connecticut, with several development deals underway in New England, including supermarket-anchored projects. One of their strategies involves identifying where specific tenants are missing in a market, such as an undersized Walmart or missing Target, and then finding the best site to meet that demand. They've been successful in mixed-use projects like the shops at Stonebridge in Cheshire, Connecticut, and the Yellowstone Airport Plaza in Montana, where they're developing a tech park in collaboration with Montana State University. Charter Realty's approach to tenant representation involves taking on smaller companies with growth potential, such as Restore Hyper Wellness and Bird Code, a hot chicken concept expanding in Boston, Florida, and New York City. Profit margins in retail real estate have been impacted by higher interest rates, but with low vacancy rates, retail remains a strong investment. Charter Realty's hands-on approach, treating client properties as their own, aims to create long-term value and profitability. Fast food enthusiasts in Dayton, Ohio, are in for a treat, as two major fast food chains, Jack in the Box and Del Taco, are planning to expand into the area. This move is set to shake up the local fast food scene, bringing more variety and competition to the market. Jack in the Box, known for its diverse menu ranging from tacos to burgers, aims to make a significant impact by introducing its unique offerings to Dayton residents. Meanwhile, Del Taco, famous for its blend of classic Mexican cuisine and American favorites, is also preparing to establish a presence in the region. The expansion plans by these fast food giants highlight the growing attractiveness of Dayton as a potential market for national chains. With the city's ongoing building boom, characterized by significant developments and an influx of new businesses, Dayton is becoming a hotspot for commercial real estate opportunities. As these companies look to establish themselves in Dayton, they're likely to contribute to the local economy by creating jobs and attracting more visitors to the area. This aligns with the broader trend of fast food chains seeking to expand their footprints in emerging markets across the United States. As Atlanta continues to establish itself as a major economic force in the Southeast, the city's legal sector is playing a significant role in shaping the commercial real estate landscape. The latest Atlanta law firm perspective report by JLL highlights key trends that emphasize Atlanta's growing reputation as a legal hub and its impact on the office market. The legal sector in Atlanta is experiencing remarkable growth, outpacing the overall workforce expansion in the metro area. Over the past decade, the number of legal professionals in Atlanta has increased by an impressive 35%, compared to a mere 17% growth in the total workforce. According to Gillum Campbell, Senior Research Manager at JLL Atlanta, this rapid expansion of legal talent is a primary driver of office demand in Atlanta's urban core. With nearly 75% of these professionals concentrated in the city center, there is a direct impact on prime office locations. The report projects continued robust growth for the legal sector, with an anticipated 7.1% increase in law firm jobs over the next 5 years, outpacing the 6.5% growth expected for the overall market. Looking ahead, law firms are set to significantly influence Atlanta's office market dynamics. By 2030, law firms will account for the largest share of lease expirations in urban submarkets, representing 18.4% of the total, or approximately 2.7 million square feet. Ryan Pennington, Senior Managing Director and Office Tenant Representation Lead at JLL Atlanta, explains that this concentration of law firm lease expirations presents both challenges and opportunities for the Atlanta office market. There is anticipated increased competition for high-quality space, which could potentially spur new development or major renovations to meet the evolving needs of legal tenants. As Atlanta's legal sector continues to expand, the city's office market faces both exciting prospects and potential hurdles. With limited new supply, competition for prime space is intensifying. Well-located, renovated assets may see increased demand as new construction options remain scarce. Early negotiation could secure tenants more favorable terms in a tightening market. Pennington advises law firms to act quickly and strategically in this evolving landscape to secure optimal space solutions. Firms are encouraged to carefully evaluate their long-term needs and consider how emerging workplace trends align with their firm culture and growth objectives. Atlanta's thriving legal sector is set to play a defining role in shaping the city's office market in the coming years. As competition for quality space intensifies and workplace strategies evolve, law firms and property owners alike must stay attuned to these shifting dynamics to make informed real estate decisions. Commercial real estate is an evolving field, requiring practitioners to stay vigilant and continuously update their skills. The industry isn't a set-it-and-forget-it profession. Instead, it demands constant recalibration as markets shift, lease structures evolve, and investment assumptions change. One way brokers maintain their acumen is through lifelong learning, both formally and informally. In California, for instance, every licensed real estate broker must complete 45 hours of continuing education every 4 years. While some may view this as a mere formality, akin to a Department of Motor Vehicles renewal, those who excel in the field understand its importance. Designations such as the Society of Industrial and Office Realtors, SIOR, and Certified Commercial Investment Member, CCIM, denote a commitment to rigorous training and expertise. These credentials require significant time, money, and dedication to earn and maintain. Beyond formal education, specialized training is crucial. Successful brokers immerse themselves in their clients' industries, staying informed about supply chain trends, environmental, social, and governance, ESG regulations, or the latest in industrial automation. Workshops and seminars on topics like 1031 exchange strategy, small business administration lending updates, or entitlement case law enhance brokers' ability to deliver better outcomes for their clients. Moreover, staying sharp in commercial real estate involves actively engaging in transactions. A regular flow of deals keeps brokers updated on market comparisons, landlord concessions, buyer behaviors, and lender sentiments. Each negotiation offers new lessons, reinforcing instincts and building a robust reputation. Interestingly, teaching others can also serve as an effective way to refine one's skills. Leading workshops, mentoring new brokers, or even writing about the industry can deepen one's understanding. Explaining complex concepts in simple terms reveals knowledge gaps and motivates individuals to address them. In the ever-changing landscape of commercial real estate, complacency is not an option. The most successful brokers are those who remain curious, coachable, and committed to continual improvement. Whether through formal designations, focused seminars, or the day-to-day grind of closing deals, they sharpen their tools daily, ensuring they're always ready for the next challenge. In today's segment, we're going to delve into the current state of Claros Mortgage Trust, a mortgage REIT focused on commercial mortgages collateralized primarily by multifamily, hospitality, and office properties. According to Ivo Kolchev, Claros Mortgage Trust has faced significant challenges in 2025, recording a loss in the first quarter, which is consistent with its performance over the past year. These losses have been primarily due to loan principal losses. However, Kolchev suggests that the loss rate is likely to be below the 25% implied by the market, indicating a potential buying opportunity in the company's shares, especially if Federal Reserve rate cuts allow distressed property owners to refinance their obligations. It's important to consider the key risks associated with investing in Claros Mortgage Trust. Ongoing loan principal losses in the short term and the uncertain timing of Federal Reserve rate cuts are significant factors that could impact the company's performance. So far in 2025, Claros Mortgage Trust has significantly underperformed the VanEck Mortgage REIT Income ETF, delivering a loss of approximately 43%. Despite this underperformance, some analysts, including Kolchev, believe there may be a buying opportunity given the potential for a turnaround if market conditions improve. Kolchev's analysis highlights the complexity and risk involved in investing in mortgage REITs like Claros Mortgage Trust. While the company faces ongoing challenges, the potential for future gains exists if market conditions shift favorably. Investors should weigh these risks and opportunities carefully, considering the broader economic environment and the specific factors affecting the commercial real estate market. That's it for today's insights on the commercial real estate landscape. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Ha Moon. See you on the next one.